Hello, welcome to the Hub71 Amplified podcast, where we have real, unfiltered conversations about everything going on in the tech and entrepreneurship scene. Today's episode is very special. We talk about one of the most important questions founders face: when to keep going all the way to the end, when to take some liquidity off the table, and when to sell completely and move on to the next thing. To answer this question, we have two very special guests. First is Leena Khalil. She built one of the most impressive success stories in the Middle East with Mum's World. And then now she moved on to the investing side to join our second guest, Basil, on building Key Capital, the first secondaries fund in MENA after Basil had a very long industrious career building different funds. So let's begin. Before we get into the liquidity point, I think the biggest question investors and founders are facing now is what to do in the current situation. Founders are really asking, are people investing? Are VCs still on? Are LPs still on into funds? Or are people on a pause and a hold, waiting for more clarity? What's the latest on the ground?
I think I'll pass it to Basil.
Thanks, I appreciate it.
The hard one.
Wow, that's a big question. So, Youssef, I think it's obvious that things have changed, right? But let's also triage this into a few different buckets. If you weren't doing before, this hasn't helped you at all, right? This is not like all of a sudden this has improved the situation. And if you were doing well before, the company's growing, etc., what people are doing is looking at two buckets. One bucket is, how does this current situation impact you? Does it actually help you? Does it accelerate? Do you have the resilience to get through it? Or is it something worth slowing down on? Or actually, there's some businesses that are just continuing right through. They've diversified, they're in other markets. I think there's one company we love that's based in the UAE, but also has business in Spain and Italy, etc. And so the diversity of their revenues really helps them. And so they're able to raise and continue and life is normal, if you like. So it really depends on the circumstance. Investors haven't stopped investing. They're just taking in the information and thinking about, how does this change my perspective? By the way, deals are happening. I know Magnet Philip, he hates me saying this, is saying that deals are down. I think they're just unreported deals. Their transactions are actually closing, but they're unreported because this is not the time necessarily to announce a transaction. That being said, yesterday I think Remote Pass announced its deal, which is again a long time coming, but it's done, money in the bank, and off they go.
And Leena, have valuations changed?
I think it's quite a funny question because everyone expects valuations to change and everyone's looking for a deal always. Like I think everyone, the trend now is you can buy property cheaper. You can't. So as long as you know the value of the asset you have, whatever the asset is, people are not moving. And the region, and we did some work on this, and the region actually is one of the fastest regions in the world to recover after war historically. Because we have stability of government, we have an income, a stable income. So there isn't that kind of, there's a fire. There's just a bit of a pause or a interruption, which is what happened in the previous Gulf War, what's happened in every single data point we've collected on the Gulf. There has been a very, very quick recovery.
What about outside the Gulf? What does what's happening mean for Egypt, for the Levant?
Yeah. Well, I'm going to answer a different part and then come back to it. So definitely international investors have slowed down a bit more, right? Yeah. If they had a transaction in flight like Stitch with Andreessen, they completed it. But are they starting new transactions? I think they're going to wait a little bit, a quarter or two, before they re-engage. And that may have a different effect later on valuations. But just as we sit here in end of May, not yet. Okay,
yeah,
just to be specific.
I think the FOMO around the region has kind of vanished a bit. We had this amazing momentum and FOMO going on.
You couldn't get a space at a conference, right?
Yeah.
And so now, there's a bit more space. Definitely the highways are a little bit easier to drive, which is a good and bad thing, depending on where you sit on that. Around the region, I think Egypt's in better form than it's been in a long time, frankly. They had their own crisis with the devaluation that was in 22, 23. And I think since then, the country's done really well. Obviously, like the global, there's some secondary effects from the conflict about, inflation and the stability. But on the startup scene, it's probably one of the better times we've seen Egypt than in some time. activities picking up, lots of great companies, etc., etc. New ideas starting to emerge. Some M&A, one pre-IPO deal that we were looking at. That's getting ready to IPO on the stock exchange in Egypt. So there's a bunch of stuff that's exciting. Levant, I don't know. I really don't have a good
I think if you look at it in previous conflicts, there's a lot of refugee issues. There's a lot of unrest just in terms of human capital. The difference today, especially in the Levant and Egypt, there's really no movement of people. It's just kind of uncertainty economically and uncertainty in supply chain. But there's no big move. So actually, if people stay where they are, human beings are kind of self-renewing. They'll find opportunity and they're built. They won't sit still. The issue you have in the Levant is every couple of years, you have a huge shift in human capital. Yeah.
Now let's move from the secondary effects we don't control to the cash secondaries that we can
Yes.
control.
Yeah.
So now, Basil, the journey typically for a founder has been, I start the company, I grow until I get to the right place to exit, and I sell, and I kind of make money. Now you guys are coming in as key capital and saying, okay, we'll throw a spin into that. Maybe you take some cash out earlier. Talk to us about that.
So the original thinking is wrong.
Yes.
The VC model doesn't
Yes.
work. It doesn't work anywhere in the world. I mean, in the US, companies that used to IPO on average in 7 years, they now take 14 years, and even they are not IPOing. Like, the market has been the slowest IPO market that they've seen in a long time. Let's see, SpaceX, Anthropic, whatever might IPO later this year might change that. But even that, it's single names or a few names. There's thousands of companies around the world. In our region alone, there's 3,500 companies. How many are going to IPO, if any? Let's just be clear. So you start off with the statistics, 1 to 2% IPO, maybe another 6, 7, 8% get through some M&A transaction, strategic M&A, etc. That leaves 90% of companies are unlikely to have any sort of exit whatsoever. They're going to have to stand on their own accord. Sure, they'll become profitable. They'll be able to generate some income. But for the shareholders that want to sell out, and especially the founders and especially the angel investors, they have very limited options and very few. We think secondaries, like everywhere in the world that we're seeing, is becoming part of the VC ecosystem to provide liquidity to those shareholders along the journey at different valuation points, depending on the circumstance of the company. So put it differently, in the early days, don't expect to be able to sell your shares. That's just not how this works. If anything, people want you to stay vested. But by the time you get to, let's say, Series B, plus or minus, maybe right before a Series B or Series C, you could already be 6 years into the journey, 7 years into the journey, depends on the business, of course. And at that point, people's life circumstances change. The cases we deal with are, people who started off single, unmarried, could spend all their time with their business as a founder, now have, along the way, 7 years later, got married, maybe had a child. They need to pay expenses. They have schools, nurseries, a house, a home, a wedding. I think we had a story of an employee who needed to sell some shares because she needed to prepare the wedding of her daughter, right? And she needed to get some liquidity. So real life events.
I think, Basil, one of the things about the question, and I think we need to really revisit that question you asked, is that your question assumes that the only value or profit taking that can be had is in the public markets. And we are saying, no, the private markets are a very rich space. There's a lot of profit taking to be done in private markets. There's a lot of liquidity that you can create, an opportunity you can create. It's just not a sexy market. But actually, historically, M&A and stake sales, and you have a lot of deaths in families, inheritance issues, and there's always a forced sale. So that's been like historically where people actually do their deals, and only 7% in the US of all companies go public. So the private market is a very interesting space, and Key Capital is saying, look here, this is really interesting. There's a lot of money on the table. Let's capitalize on that.
Yeah, that's what we're doing. We're bringing a solution to those events. And so by bringing that capital, we're making offers to shareholders who want liquidity along the journey. There are a ton of questions to answer on this. How do you do it? What's the price? There's all sorts of things that have to be taken into consideration.
But we're not sharing the details.
But you are making these offers at significant discounts, like any secondary would.
And to be honest, and sorry to interrupt you there, but I think also that not always. Because some companies are growing at a rate and their branding is such globally and locally that people want access to them at any price. So it's access and discount, both.
But yes, discount.
But then why wouldn't I hold on to these shares and ultimately sell them at
because
the full
life
price?
events take over, because people need liquidity. And even if you don't, it's a diversification game. You put in, let's say you invested as an angel investor, 3 tickets of $25,000 each across 3 companies. One didn't do well, it's gone. Another one's doing okay, and one's doing incredibly well. It's worth 10 times that. It's still on paper, right? It's still not realized. And being able to sell even half that position will allow you to pay back all the investments you've made, have money left over, invested maybe in something new, AI or whatever is exciting that you know, biotech, etc., that's exciting, and you still have half left in that company. So what we're saying is it's at simple, it's a smart move by smart investors to diversify. And on the other side, it's critical for people who need to manage their life. 10 years in today's world is a long time. You know, you start single, maybe get married, maybe get divorced, I don't know, right? You go through the whole journey in 10 years. And founders, shareholders, employees, angels, all are needed liquidity. We've gotten more phone calls in the last couple of months, just as people look at the world around and go, you know what, I want to take some money off the table. I want to go back to cash because I want to put it in something else, you know, or I just don't want to have this risk.
If you've moved on as a co-founder, there's a lot of cases of co-founders moving on and starting their own business and needing cash for their own business that's actually outperforming maybe the great shiny asset that they were part of. So,
and that's very clear on, let's say, angels, co-founders left, etc. Now, for the main founder who's staying, some VCs would say, I don't want him or her to diversify. I want them to be all in.
There's a very famous AI company. The founder needed money because the schools that the kids were going to were getting very, very expensive. So they liquidated something like 1%. And instead of the company having to discuss a salary increase or to change the package, actually that was a great liquidity event to give them some certainty, personal certainty.
Yeah, it is true though. VCs, just for clarity, I think most VCs, most institutional investors would say, we want to make sure the founder is well motivated to keep growing the equity. And so there is a balancing point. They can't, you know, they mostly won't approve to sell everything because that has a different circumstance, that has different outcomes. But at the same time, really smart investors would say, if the founder doesn't get some liquidity, just like they're getting liquidity along the way, then why would they also stay motivated? Because it's like golden handcuffs, right? It doesn't. At some point, you need to release some of that to be able to continue to improve your life. So there's a balance. By the way, I should say, for those of people who are skeptical, secondaries are happening in today's market all over the place. There's really not a transaction, Youssef, in the region where when there's a primary happening, there's a secondary happening with it. It pretty much becomes standard. Some companies are doing regularly now buybacks from ESOPs for their employees, like 10% of their ESOPs, just to, again, like think of it like a bonus, right? It's it's not life-changing money, but it's additional capital that motivates employees to keep working for next year's ESOP.
Yeah, I think one of the founders, I heard the founder talk about it in a lovely framing, and he was saying that my company is growing at a rate, I'm taking huge risk at work. At home, my income is limited. I can't take the same risks. I'm a different person. I'm having to think very conservatively about my own life and in kind of big numbers at work. So if I can normalize that and grow with the company at a reasonable percentage, then that's good for everyone.
Now, Leena, value proposition, very clear, okay, for founders, for angels, etc. Now, if I'm an investor, I want to, looking at different funds, I have a private equity fund, I have real estate, I have a normal primary venture capital. Why would I, as a limited partner, put money in a secondary fund? What's in it for me?
So it's basically just another asset with another risk profile. So if you want to access the tech high flyers, and you're hearing a lot about them, and some of them are really outperforming the market, the entire market, but they're private companies. You don't only have to invest in VC for a 10-year plus 1+1. That's not the only product. There are other products. And secondaries give you that shorter timeline product, and that might suit you. It also removes the early stage risk. So you don't have to go there, risk your entire capital.
It's a much better risk return.
Yeah.
I mean, if you ask me, as someone who's done VC for quite a while,
Why haven't we done this?
I would have, if I know what I know today, I would only do secondaries. And again, I'm biased. It's what I do. It's our job. We're obviously excited about it, right? That shows. But let's be clear. It's a very different risk profile. When you're investing through a VC, you are hoping that 1 out of 10 of their investments does incredibly well and will make up for the 9 that will probably not do well at all, crash and burn, frankly, right? That's VC. That's not secondary. Secondary says, for that one that's doing well, who are some of the shareholders there that need liquidity, and can we get into those and still get the compound effect of growth at a later stage?
But not at the rate of the people who came in the early days, but at a more kind of less risky position. We're reducing the risk. And I think that's very important. And if you look at the statistics, 99% of all secondary funds return the capital versus VC, which is not the case. It's a lot lower.
So, Bas, let me ask you Leena's question. If it's so obvious, like you make it sound, why is it happening for the first time in 2026 for you guys being the first secondaries fund in MENA?
It's not very happening for the first time. It's happening. It's just that there's no clear guy you can go to. It's happening very informally. It happened in Mom's World. It's very broken. It's very difficult. So we're just taking something that's happening and making it easier and basically allowing capital to allocate to it.
So Leena answered the question.
Asked it and answered it.
All right, listen. I think I'll say this. The market needed time to mature. There is a time and place for everything. And we needed to build the foundations in the region of startups. You can't have secondaries if there are no startups in the first place, right? And by the way, we still need more, right? This isn't to advocate that we don't need more capital going into early stage. This is to advocate that as the market matures, we now need to segment and triage different products, if you want to call it, or different investment strategies, or different ways for people to access the market based on their risk return. I will always be a sucker, by the way, for an early stage founder that just, wins my heart over. But that's an investment I'd rather do from my own personal pocket. For institutional money, for LP money, for professionally managed money, we think secondaries at this time in this market provides an incredible return risk management. You're not taking all that early risk. You're getting good returns, but you're adjusting for it. But at the same time, you're going to miss out on that 100x. You know what I mean? Like, that's not what we do. We do the 4, 5, 6, 7x types of return, depending on where exactly we enter a cap table. And so you need both, I guess, is the short answer. And again, the rest of the world is catching on this everywhere, by the way, right? The US has always been the leader. It's always deeper. Comparing to the US is not the right way. But if you look at Europe, secondaries is growing there very fast. You look at Asia. So this is a global phenomena. We're just proud to be the first to pioneer it. We've been in a lot of discussions with people about how do we set standards? What are the rules? Like I mentioned earlier, ESOPs. Giving ESOP buybacks to employees, what are the rules on that? Does anybody know? What's appropriate? Do you buy all of what's vested? Do you buy 10% of what's vested? 25% of vested? What are the norms that we need to establish? And so our discussions aren't just about investing. It's about helping founders set the norms that will hopefully grow the industry more.
But Leena, you're saying part of the reason you're de-risking is you're coming in later and buying shares later. But at the end, some of the shares you're buying are the earlier shares, are the founder shares, are the angel shares, which may still be common shares or may still be shares where there's so much more preferred shares that sit above. So are you really de-risking, or you're just still buying the high-risk instrument, you're just buying it later?
You're de-risking the position in the company's lifestyle. So it's the maturity of the company rather than the instrument itself. But the price will have some kind of discount, coming back to your discount, baked in for the instrument being a lower quality instrument, let's just say. So we're looking at all the variables, the quality of the company and the quality of the asset that we're buying.
Yeah, and I think if you want the financial, if you're a modeler, let me make it clear. The common shares really have no value until a certain point. And that's usually around Series B, when common shares go from 0 to some value, right? And that's when your amount of money you've raised is smaller than the total value of the company, if that makes sense, on a proper financial model. So the math is not hard to do. We think that people who buy preferred shares early are doing it on the basis of believing the idea and the founder, not on the basis of financials. What we do is based on proper financial. These are mostly companies growing fast, profitable, usually all the way to the bottom line, or just breaking even. So we have very specific criteria. It's not any company, any time, right? It's very specific things.
And these criteria, Leena, are part of sometimes the founders' problems, right? Because you want very fast growth and you want profitability all the way to the bottom line. How can someone do both?
I think when you're looking at an early stage company, it's hard because you're doing everything product market fit, team, building the team, trying to hit profitability. So there's a lot of moving parts. I think as the company matures, and that's where we look at it, there are set criteria, and we're really kind of balanced in how we look at a company. So if they don't match our set criteria, including how able are they to exit, whether it's through IPO, some liquidity event. So I think just looking at the company later, you're able, the team is stable, the company is mature, the product is mature, and the markets, their positioning in the market is clear. So you really have de-risked a lot of the variables. Yeah.
Every entrepreneur is a serial entrepreneur. They're building multiple businesses on top of each other inside a single company. To put it differently, they need to show profitability in the majority of the segments or the customers they're going after. Where things get complex is that some founders, in my humble opinion, in this region, mix too many ideas together all at the same time. What we love to see is you come in and you say, listen, I'm profitable in real estate, tech in Dubai, and I have X amount of customers. I sell them whatever product you sell, partial real estate, whatever your proposition is, and I can show from my acquisition all the way through, I make money on this. Now, by the way, I've also expanded in Abu Dhabi and Riyadh and in 6 other places. And because I just started on those are not profitable, so my net position is negative. That's okay. For me, it's still a business that's profitable and is making bets on multiple markets. If you can't present your story kind of taken apart and show the profitability, that's where it gets complicated for investors. But once you show that in at least your core market or at least one other market, you are profitable all the way through, you have a business. Now, shareholders want to give you more money, you want to bet on more geographies or more client segments, all the power to you. Let's build, let's keep growing. And that's what an entrepreneur is. Every entrepreneur, at least in our markets, is a serial entrepreneur in my eyes.
Leena, if you had that time machine, would you sell shares in Mom's World to Key Capital?
I like that question. I would offer Key Capital's kind of services to all the angel investors that were with us.
But you would keep your own shares?
I'd buy their shares using Key Capital's structured product. So I would get Key Capital to help me buy a larger share of Montserrat, yeah.
Do you offer that, Basil, as a proposition for founders?
Yeah, it's one
No, we offer it, not Basil.
No, just the question, but just trying to have some gender balance in the question. Reverse gender balance.
Yeah, there is a problem with that.
I mean, listen, we sat so many times during the Mom's World exit and discussed, the options, and I've seen this now 100 times. There is moments when investors need to get off the cap table when it's not suitable for the founder. And there's no option in the market today, unlike the US or unlike Europe in some market, where the founder themselves can buy back their cap table. So one of the key things we do is, yes, we do what's called collateralized loans, preferred equity, if you want a different name for it. There's lots of different ways to structure this. But ultimately we say, you want to buy the shares? Even better. You're going to have to put some collateral against it. So we'll lend the money if you want, or we'll invest with you to buy those shares. But we need to have enough shares in this SPV in order to make sure that it's protected as a structure. Okay?
And
so we'll absolutely do that,
yeah,
because it gives the founder the ability to buy the cap table, especially if they've been over diluted or they're coming at a point where the investor wants to exit, but the company's still growing really well, and there's a misalignment of expectations at that moment.
But I think it's a lovely product. because it means suddenly you have an advocate on the board, because you're buying with him. So he'll decide when the right time. He has so much more insight, and you're kind of living the company day by day rather than getting an update and then having to make your own decision. Your partner is the person leading the company or one of the co-founders. It's a brilliant product. Yeah.
Would you also advocate sometimes, so obviously there's a situation where, let's say, an investor has made money, they want to take money off the table. Sometimes it's the other way around. The company has just lingering by, becoming a bit of a zombie, and investors like, just give me 10 cents on the dollar, 20 cents on the dollar, get me out. One is, do you advocate for founders and companies doing that? Because sometimes also then the connotation of people having, let's say, written off the investment in a way can also carry a negative reputation. So one, do you advocate for it? And two, do you do it? Do you clean up cap tables that way for companies which the companies may not be doing great, but the deal you have on the table may be great?
But at the end of the day, we have a responsibility to our LPs. And I think what's really important is we're not out in the market looking for companies or deals. We do a lot of work around kind of mapping the MENA market and understanding who's leading in every sector and really outlining we want to work with. And then everything else below that is really if there is bandwidth and if it really makes a lot of sense. But the 90% of our work is outlined already for the next 18 months.
Yeah, and there are too many great companies for us to have to chase other types of opportunities. That being said, Youssef, what you suggest is what I call special situations or different circumstances. That's not what this fund is set up to do. This is set up to give liquidity for the best performing companies to their employees, to their angel investors. That's what we're doing. It's a very nice win-win-win for everybody type of thing. The one you're talking about can be trickier, requires a little bit more diligence and work, because the fact that it's something that someone's willing to let go at a lower price and another institution would require us to put more effort into understanding the asset and making sure that that price actually is representative.
And maybe value creation in the long term, which is not something...
And it may require value creation, etc. So hopefully Fund 2, maybe we can widen the net, but I think for now, there's just plenty to do on this strategy.
And on this loan structure you're doing, can this be done in a Sharia compliant way?
It is done in a Sharia compliant way.
It is done in a Sharia compliant way.
It's very important that it is.
Okay.
Yeah, we have a Sharia certificate for the product. It's done. I hate to use the word loan because it's not a loan. It's a partnership where we're providing capital and the founders providing shares, and together we're going out and buying other investors, and we have structured it in a way that it's the full-on risk and return is done in a partnership with the founder. We're not laying on top of them an additional burden. We're carrying the weight with them to get another investor off the cap table because they want to go, but we can willing to share that risk.
So Leena, you talked about, let's say, the personal situation of the founder and how this can come into play. Now let's talk more about the company itself. So assuming I'm a founder today, I'm looking at three options. I have a primary only term sheet. I go all the way, skin in the game. I have a secondary option. I take some liquidity off. And then I have a sale term sheet where I sell the company and I start something new. Now, parking my personal situation for a second, how do I know, does it make more sense for me to start something new, to continue to run this one to the end? How do I make that calculation?
It's an interesting question because I don't think in this circumstance, when you've spent so much time building your company, that selling it ever makes sense, by the way. Even if you make a lot of money, you always feel like you shouldn't have sold it. And I've spoken to a lot of people who've done super well selling, but they always look back and said, I could have done more.
But is this rational? It's just an endowment bias. You have something, you think it's worth more than it is.
It's like your kids. It's just another child. Like you've built this. It's like sweat and blood. But if you have the three, the good news is you don't have to choose. You can actually do all three. So key capital will come in between primary deals. So we're not coming in instead of or to replace. We're there all the time. If you're a great asset and you're growing, we can come in and the founder can use us as a support the whole time. So it's not either or, which is good news. You could do a primary and then you could sell some of your shares and then you can then proceed and do an M&A. So you could do all. And if you are, if you plan financially and have the right board, you should be able to. The problem is there's a lot of dysfunctionality in terms of decision making. People behave differently under pressure. And when we have a geopolitical situation like the one we are in today, the resilience of the team matters, and not everybody can perform under this pressure. We saw it in COVID.
Yesterday, I was on a phone with a founder in Egypt who got an unsolicited offer to buy someone to buy his business. And he's in the middle of a raise. And it was an offer from an entity here in the UAE. And I'm going to use Arabic, and I'm sorry for the podcasters. Maybe you guys can put a translation. This is what I said to him. بص اللي قاعد جوه الغواصة مش زي اللي قاعد بيتفرج من بره الغواصة. You know, if you're inside the submarine, you have a certain perspective. If you're outside the submarine, you have a very different perspective. And I say that because the founder is the one who's inside the submarine, having to drive and navigate a very difficult one. You know, someone sitting on the beach telling you buy, sell the business is a really luxurious place to be sitting in, but very frankly, unhelpful. So I was saying that to him to say, I can only share my opinion. And here's what I know to be true. Founders who've exited can raise money for second-time companies a lot faster, a lot better than those who've never exited. Because it shows that they're willing to take the money and carry the duty of that burden. Okay? An exit isn't the end of the journey. It's the end of that journey of that asset and that idea. Many time founders can go on and repeat the same idea. I mean, just take the example of AI today. But let's get serious. Should you pivot your business to AI? Or should you sell the asset of whatever you built and maybe build something very similar to that idea using AI technology?
And faster.
And make it AI native and maybe faster, maybe more cost efficient. And those are, I don't know what's right and wrong. I can't tell a founder, we can't talk so generally about this. Every situation is so unique and special. But in my eyes, as the person sitting on the beach looking at this submarine, right, I guess like that metaphor I was saying, it seems to me that in some cases, selling the asset, returning the capital, even if it's not to the full value that you were expecting, may lead to better things in life, even if you want to stick in the same field and do the same thing. I'm willing to bet Mom's World today can be rebuilt faster, quicker, with a lot less capital, and probably by the same team, frankly, just given the fact that they've done it once before, than trying to modify the same technology, the same kind of business over and over again.
But I think I think we talk about M&A too much and exits too. I really do think we need to talk a little bit or spend some time talking about building international companies that compete on an international scale, because, it's coming up a lot now, and it's something that's very dear to my heart. You start and you only think regional, and you start in the UAE and say, okay, I'm going to open in Saudi. The world is not just the GCC or the Middle East. We need to start competing globally, and we need to be acquirers rather than targets. And I hear it now more and more, and I think Fadi Ghandour also had a podcast about that, but we all feel the same way. We no longer want to be in a region where we're just the target.
There's definitely an argument for criteria for underwriting new investments will include a better scrutiny on international plans.
Yeah.
There's no doubt in my mind. It's an insurance policy. It is where the world is at today. As we go from fintech to AI, kind of in the cycles that we've been through, you're competing globally, whether you know it or not.
So wrapping up, a founder today who wants to take one practical step to make their business attractive, to create the most optionality around being able to create liquidity, what should they do?
They should call us. Very simple. It's so easy.
I'll be a bit more technical. Yeah. It's important to put in shareholders agreement very clear rights of first refusal, very clear clauses that enable the founder to be participating in buying back their company.
That's
one of the biggest mistakes we see, and I'm being very technical. I know.
No, do it. I think
okay, we'll do the reels from Leena's part, and then your part can go to the long form.
Exactly. But the point being,
and he loves that because it means that people will spend more time.
When you're doing preferred shares, and again, the standard was that the rights go to the preferred shareholders. And my question is, why aren't some of those rights equally applicable for the founder? And the best cap tables I've seen, the best shareholders agreement I've seen, are where the founder also has the right to buy the company's shares. No one's doing you, it's not a favor. If you want to buy them, you should buy them. You're just a shareholder like everybody else. And so I mentioned this small technicality because when you summarize everything we talked about today, 90% of founders are going to end up making these businesses a lifetime business. They may change, they may move on and bring a CEO or whatever, but in terms of ownership, they're going to have ownership for a very long time. They will give this to their children. They'll give the shares of their companies to their children, and they'll give it to their children's children. And I think we're creating a new generation of family businesses across the region through the tech investments, and making sure that the founder always has a meaningful piece, has an ability to bring investors on and off, is an important part of this whole ecosystem working well.
Leena, Basil, thank you so much for coming on the Hub71 Amplified podcast. It was incredible having you.
Thanks, Good to see you.